So when we look at, studying this particular unit, which is business environment, the reason of, inclusion of this unit in level 4 in the course that you're doing, business and management, is to primarily understand, the internal and external environment, which basically affects businesses or organizations, and how do you as a person, when you in a business or an organization, then look at, understanding these factors with regards to the impact they have. And then at some stage, the idea would be to also try and understand, things in terms of the key models which you will use at some point in time to analyze information, with regards to the importance of that information with regards to the business. So there are a couple of sections which relate to economics in business, and the reason why we look at is when, as you know, that when you particularly say work in an organization, or an organization which produces goods and services, is basically, an organization which provides these to its consumers for purchase. They are in some sort of a business. That means they make these goods and services, or produce these goods and services, and then they basically make it available for consumers to buy. In the terms of everything which happens within the organization and also outside the organization, there are lots of things which affect the trade or affect the the operations of the business. So here, when we get into the nitty, what we need to know is, first of all, we need to understand what are the different types of organizations, in terms of limited companies, types of companies, those things we will understand. And once you understand the structure, of the companies or organizations, how they are formed, what requires them to have this structure, regulation. We'll also understand a bit of legislation, like the Companies Act, and the registration has to be done as a specific company on different, in different countries it is different, but pretty much follows the same pattern of, legal requirements which are there. And then at some stage, what we will do is we will start to understand how businesses are affected by government policies. So policies like, fiscal and monetary policy. We will look at things like exchange rate, inflation. We will also look at how complex business. And in order to study this, we will look at a lot of models, when I say models, we are going to look at theoretical frameworks in particular to be able to do this analysis. And then we'll progress on to looking at studying and understanding what are the external market forces in particular which affect business. So they could be that, as you know, most companies today have products and services which go across geographies. So they sell products and services internationally. How the international rules and regulations affect the business. You see a lot of people now employed by organizations. They come from diverse culture, background. So how the structure and the culture of the organization, shapes up. And these things are important for us to understand if at a very basic level, because when we start to work in an organization, we need to be able to get to grasp with some of these things pretty much, quite quickly. And some of these key bits that we will study in this unit will also relate to understanding, certain types of trade agreements. So when we look at the World Trade Agreement, we look at WTO as an organization, we look at the European Union in terms of, when UK does business with the rest of the countries and we are going out of the European Union. So there'll be a bit of that understanding. In the Asian context, we have SAARC, the South Asian Regional Cooperation, which is a setup which basically is, I think about 7 or 8 different countries are a part of that, including Pakistan. So those setups is what we need to understand when we look at business from a point of view of internationalization. That means it's a global business. So as we go along in this unit, the basics would be to start with understanding the company, the structure, what are the people involved. Then we go on to understanding the policies and, environment which affects the business in terms of its operation, what legislation is must they need to, followed by we will look at, the market forces which affect, which is external environment in particular. And then we look at the internationalization of the business. Now, in order to develop detailed understanding, what we've done is we picked out one of the recommended books on, business environment. And this book is something which is now available for you to look at and read. in the Moodle. And here, what we will do is, this is a very extensive book which will cover this unit in absolutely great detail. So there'll be some bit of reading that you will do, apart from the discussions that we do on the webinars. But the additional reading will help you to also crystallize some of the thoughts that we discuss using PowerPoint slides. Plus, it will also help you in, doing tasks and assignments, which is set for this particular unit as we go along. Now, and every session that we do after that, what I'm going to try and do is basically refer you to some pages in the book. I'm just quickly skipping through some of the pages to go to chapter 1. And in this case, what we're going to do is, once we do the session for learning outcome 1, I'm going to try and recommend you to look reading, a few pages from the book, which helps you further detail out what we've discussed in the webinar. Is that okay? And the book will also give us examples to discuss. There'll be a few case studies that we could discuss, and those bits will help you to show application and practice when you start doing the assignment in terms of doing the tasks. So let's look at the presentation, for learning outcome 1, which is what we will go through today in particular. And at some stage, what we will do is, when we summarize, feel free to ask me any questions or anything that you don't understand. So in the first instant, we're going to look at, the overarching, task 1 that we want to look at in particular, to understand, the different types of organizations and what are their purpose. Now, when we look at, an entity or a business entity being formed, something which operates within an environment, we normally look at the, formation of a company. And when you look at the formation of a company, what tends to happen is that they have to be set up as a legal entity, because they have a lot of people which will work within the organization. So the organization, when it is set up as a legal entity, has, the written policies and procedures, so that they can protect both the employer and the employee. And when we look at that, so sometimes when you set it up, we look at different types of companies, we look at different type of structures and different type of legal entities. Now, in our case, when we look at specifically with regards to the classification and the type of organizations which are normally called, we basically look at 2 types first. We look at public sector and we look at private sector. The public sector is defined as organizations which are primarily owned by the government or the state. And here, these organizations typically provide basic infrastructural services to, its citizens, or, to people in that particular location, country, or geography. Private sector organizations are organizations which have ownership from individuals or consortiums or, a group of individuals. And these organizations have to follow rules and regulations set by the Companies House, or maybe some sort of an act or legislation present in each and every country. So in the UK's context, we have something called the Companies House. And when they look at forming a company which is a private sector company, which operates in the private sector, that means it provides services, and in return it will make profits. So there are lots of differentiations and definition of how we define, a private sector company. But basically, companies are in the process of, making profits, and they have investments which have been done by, individuals, or I would say, consortiums. They would look at, basic objectives of, basically having some sort of a return on investment, or, some capital. And here they provide services which have to be paid for in general, if you avail of their, services. So when you look at a list of large private sector companies in the UK, we look at some of the big brands like Marks and Spencer, Next, which are, or Tesco's, for example. These are all private sector companies, and they've been set up, because they were originally businesses. Once they were set up, their main aim was to make profits and obviously provide some of these services to consumers. And there is a part ownership of these companies, which is typically through the ownership of shares and bonds, which is in the domain of public. Now, if we have to broadly then kind of categorize private and public sector organizations, what we do is, in the private sector, We look at different categorization, which is things like sole proprietorships, partnerships, cooperatives, limited companies, and also public limited companies. And then in the pure domain of public sector, businesses, we look at state corporations, like electricity boards, water boards, and things like that. And also we look at, companies which are owned by the state nationalized industries or nationalized companies. So things like, if you look at, say, electricity producing companies, you look at companies which serve the defense sector, for example, or are sensitive in terms of producing goods and services. Those companies are generally owned by the state or the government in that particular country. So going forward, what we did is trying to understand, what are the characteristics of each different type of company structure under private, sector first. So in the case of sole proprietorship, what we look at is, these are, as the name itself gives the meaning away, sole means you have only one person, which is primarily the business. And here in sole proprietorship, the person who kind of starts the business off, or when we look at examples of shopkeepers or people who run small businesses, and wherein they are the mainstay of the business, being the owner, the director, and also the person who retains most of the profit, they tend to fall into something called sole proprietorship. Now, most businesses actually start off with sole proprietorships in some sense or the other, and in general, when we look at these businesses here, what tends to happen is that you will see any profits or losses which the business makes at the end of the financial year or at the end of the term is actually the direct benefit or disadvantage of the owner of the organization. So this is the simplest form of setup which can be done, and here the owner of the business actually bears the entire risk of running it. Now, if the business fails, and the business fails or collapses or folds, the owner of the business basically will take the full responsibility. And that is why and if the business makes a lot of profit, it's doing quite well, then in that case he pockets most of the profit in the money being generated by the business. So there are advantages and disadvantages. Now, these are listed on the slide. So when you want to start something of your own, which is an enterprise or a business or a commercial venture, what most people do is they set it up as a sole proprietorship because it's quick and easy to set up, does not require any legal incorporation. That means not much legal documentation is required. And then in terms of startup costs, the costs are very low. So you might want to start off a small business and you could start it from your own house, own home. You might not want to employ people at the beginning, so things like in terms of office cost and other associated costs with regards to manpower and things like that are kind of minimal. Now, the gain and the loss is directly related to the owner, and because sometimes you will see the owner, and the owner is also the director or the the main person in the business, decision making is very, very simple. And decision making is quite efficient and quite quick or prompt. And sometimes you will see that in some countries in particular, sole proprietors or people who produce goods and services may not need to be filing, say for example, legal papers or legal, papers in terms of publishing their accounts. Essentially, they might have to, do the accounts. They might have to submit tax, everything that is mandatory, but their publishing of accounts might not be a legal requirement. And disadvantage being that, sometimes when you have to start a business and you need a startup capital or you need some money to start the business, then here, because you are the only one who's starting off and the business does not have any, kind of reputation or past experience, this tends to have a bit of a disadvantage because you can only put in savings, or you have to depend on funds which are your own generated funds to be able to start the business. Now, apart from that, sometimes you will feel that because you're a small business and you kind of have started it yourself, it is sometimes difficult to kind of attract the right talent or other resources who will come in and do the business or be a part of the business. And sometimes you will see that the operations are totally dependent on the owner itself, because the decision making happens with the owner. Simple example is, if you are a shopkeeper and you have opened up a shop and you offer some services, what will happen is that unless the owner comes in the morning to open the shop, the services or people or customers will actually not start to walk in or come to the shop to buy goods and services. So if you open a shop at 9 o'clock in the morning, you might have customers coming in early. The business might be good for that day. But if for some reason you end up opening the shop, at 12 o'clock, that would mean that, because the shop is shut, you might lose a lot of business or customers, because the entire operation is actually dependent on you. So sole proprietorship in a nutshell are businesses which are most businesses which start off as this type of business, where the owner thinks of an idea or comes up with an innovative idea and he decides to start the business. There are lots of advantages, disadvantages. Advantages being that documentation and legal framework might not be very mandatory or strict, but disadvantages being that there are high levels of risk associated with it, but also high level of gain, and most of the investment into the business actually comes in from the owner or the person who started the business. So if you look at ladies who work part-time, people who work as contractors, people who provide services because of their skills, like typical example here would be plumbers, electrician, people who run their own shops or offer services which are variable. That means they only offer these services on the weekends. Sometimes you will see tuition, which provide tuition. They tend to be sole owners and sole operators of the business, and that is why these businesses fall into something called sole proprietorship. Is that okay?
Right. Yeah.
Okay. Now, as the business tends to expand, what will happen is you will see that you need more injection in terms of cash into the business. You might also want more individuals or people to come in and work in the business, and that would at some stage mean that if you're looking at expanding the business, or if you're looking at growing the business, or if you're opening a branch of our business in a different location, then in some of those cases, initially, sole proprietors will develop into something called partnership. But sometimes people also form partnerships and start a business. So when you look at accountancy firms, when you look at solicitor or legal lawyers, legal firms, or firms which actually or basically people which offer professional services, they generally tend to start a business in the form of partnerships. So what will happen is, an example is, if you look at large accounting firms, PwC, PricewaterhouseCoopers. Now this is actually a combination of 3 different companies. If you look at Ernst & Young, again 2 companies. So these companies were essentially professional chartered accountants or large partnerships, because what they did was, when they started the business off, there were 2 or 3 accountants which got together, a group of accountants which got together and started offering certain services. But as the business grew, what tended to happen is that they kind of started to amalgamate, other partnerships which were essentially offering the similar services, and brought it under a big brand. So some of these businesses involve, in general, more than 2 individuals, or it could be up to 20 individuals in a partnership, as far as UK companies law. And here, what they tend to do is, the reason of coming together is that they normally see a synergy, that they have functions which are mutually exclusive. That means if I do something, then that function is exclusive to me, and you on the other side, who are a partner, kind of tend to do other function. An example here of that would be that when we look at partnerships, I might come in and do teaching, you might come in and do sales, somebody else would come in and do marketing, somebody else would come in and do operations. So here we are all working in the same setup, but we have different functions to perform. And that is why what we do is we become equal partners. And sometimes you will see that these companies or groups of individuals coming together, they tend to form something called a partnership. Now here, the key difference between this and sole proprietorship is that sole proprietors, you have only one person running the business. In this case, you have many people, up to 20, running the business. Here, the profits and the liabilities are shared by the business. That means if the business makes a lot of profit, it is going to be equally split up depending on the partnership agreement which has been done. Now, sometimes you will see 2 people come together and they become partners. They say, okay, I own 60% of the stake because I've invested 60% of the money into and you're 40% stakeholder. But at the end of the year, if the business makes, say, £100 or 100 rupees as profit, that is going to be split as 60/40 because that is written in the partnership agreement. So here, partnerships essentially work wherein the profits and liabilities of the business are shared across the number of people in the partnership. Again, this is seen in terms of the advantage. It is easy to form. A lot of people do not need to do legal paperwork. A memorandum of understanding, MOU, is essentially put together, which basically defines the roles and responsibilities of individual people in the organization and what role they play, how much stake they have, and that seems to be a legal document as long as everybody signs it and everybody kind of the document. Now, because there are many people, some of the advantages will be that a lot of people can put in the capital into the business if it is required to grow the business, buy an equipment, or take more office space, hire more people. So sometimes you will see different partners investing into the business, and they then automatically kind of augment the agreement depending on the stake or the money they are putting in. Expertise tends. Why do you think a lot of people come together in this business? Is because they feel that they can contribute on their skills, on their experience, and they have expertise which nobody other has, and that is why they want to bring that person into the business so that will help bridge the area in terms of gap or help the business grow in a different field. So look at sticking to solicitors. Sometimes you will see a solicitor or a legal business starts off as a business specializing on immigration, but as they grow as a business, they do feel that they also have a lot of customers coming in for asking for commercial law or family law, and then what they do is they say, okay, I'm a specialist in immigration. I want you to have a partnership with me, and we can work together on this, wherein you handle family law, I handle immigration, or then they bring in a third partner. They say, okay, you handle commercial law and I handle immigration, and somebody handles family law. So with the three of them, they then become partners to be able to run this business. Now, because this is partnership and there is room for them to grow up to 20 different partners in the business, there is room for scalability. That means they can be up to 20 solicitors in the business, or up to 20 solicitors in the business, which can actually come in and offer services which are maybe exclusive. If the immigration side of the business becomes too big, then some wherein the side of the business is getting more cases, so one person is not able to handle, and they bring that in so that the other person comes in and takes the load, so becomes an appropriate percentage holder or a partner within the business. Is that okay? Yeah. Now, the third type that we look at is private limited companies, or PLC. Now, private limited company is, as the name says, limited. It basically has, a clear differentiation between, individuals owning the business and owning the liability of the business. So here, a private limited company is actually owned by individuals, which could be classified as owners. But in order to formally document the structure, a memorandum of articles is formed rather than a memorandum of understanding. And this MOE is now then set in stone as per the legal requirement at the company's house, or maybe an authority which registers these companies. And the partnership stake, or basically partnership or stake within the organization, is actually depicted through the form of something called shares. So because this company then operates in the public domain, what tends to happen is that this type of business is then required to be kind of formed as a entity, and under the company's law, this entity needs to then maintain its books of account and publish the books of account every year. And this normally follows maybe the financial cycle or maybe the accounting year set for in that particular country. So when you look at in the UK, most of the accounting year, regulates from 5th of April to 5th of April of any year till 4th of April the subsequent year, and that becomes the annual cycle in which the company accounts have to be submitted. So here it becomes a legal requirement for you to be able to submit accounts in a particular format, and that accounts have to be then maintained and submitted by a competent authority like an accountant or a chartered accountant. And in cases, if the turnover is large enough and it's over £6.5 million, those accounts need to be also audited before they are submitted to Companies House. Now here, because you have become a company, expansion and bringing in new people or new investors into the company as partners is easier, because all you have to do is issue shares. So if I have a company limited by 100 shares, that means some shares will be with me, some shares will be with somebody else, but the total sum of the shares which have been issued is 100. Now, if you have to look at in bringing in new partners, what will happen is one of the partners might have to give 20 shares and get some capital against it, because he's doing away with his shares in terms of the control of the company. So sometimes you will see in a limited company there are more than three shareholders or more than two shareholders, because the let's put it this way, the ownership of the company is guided or basically guaranteed by the number of shares that you hold, and this then allows you to become a director or hold a responsibility position within the organization. PLC essentially tends to be, private limited company tends to be a company which is owned by individuals, but here the ownership is basically based on shareholders pattern, or the number of shares that you own in the company. Now, the key difference between a private sector company, private limited company, and a public limited company is when the shares of the company, in this case public limited, are traded on a stock exchange. That means the ownership of the company can be distributed to investors on a stock exchange. Then that company then gets into a classification of something called public limited company. So an example here would be when you look at private started up as a private limited company because he had 100% ownership. But when he ventured into other businesses would mean that he started the railways business or the airline business, then you would see that he needed a large amount of investment to happen in the organization. Buying aircrafts or leasing aircrafts, or getting onto large contracts which allowed him to offer services like mobile phones, railways, and also airlines, meant that his company needed a large injection of capital to be able to buy some of these assets and then offer these services. So what he did was, because his company was quite profitable, he listed his company on the stock exchange. And listing the company on stock exchange meant that they charged a bit of premium to sell the shares, but the ownership of the company then went across to public. That means you could own 2 shares, 200 shares, 2,000 shares, or depending on what you could afford. And when you own these shares or bought these shares on the stock exchange, you became a part owner of that company. So here, the ownership of the company is distributed amongst a wider set of people or audiences, and these people or audiences could be investors, angel investors, people who invest into companies. It could be normal members of the public, and it could be even family members within, or relatives or family members within your own family, or near dear ones that you know. Now, when the company becomes, and when we use the term called publicly traded company, that means the shares of this company are traded on various stock exchanges. So you might list the company into London Stock Exchange, New York Stock Exchange, Karachi Stock Exchange, things like that, Bombay Stock Exchange, wherever. But as in when you invest and list your company for public to buy shares or stake into it on different stock exchanges, what you're doing is every time you list a share in a different market, you are diluting the shareholding capacity of the company, but that dilution is bringing in more money, because a lot of people are going to buy your shares basis the business and the idea or the profitability of the business. They want to own the business, and because that will bring in money, that allows the company to grow. And because that allows the company to grow, it also means, on the other hand, that the shares, the ownership of the company in the hands of the main person or the founder of the company starts to reduce. Sometimes you will see that owners will sell up to 49% of shares but retain 50%, 51% because they want the majority stakeholding in that organization. But as the companies become big, wherein they churn a lot of turnover, make a lot of profit across the year in any financial year, what owners do is they sell their stake in the company to public or to investors and take out large sums of capital by selling that percentage or that share in that company. So they are relinquishing control. Essentially, what they're trying to do is they're trying to relinquish control to other people for them to come in and invest in the company and also own the company to a certain extent. And that difference is a big difference which kind of separates the classification of a private sector, when you say in private sector, private limited companies from public limited companies. Now, one of the key things that you will see is somebody might invest into the business. Say, for example, if you run a business, you might not want to have the conversion of your company from private limited to public limited because you do feel that you have enough cash flow, you have enough profits and enough retained earnings within the business and you do not need a fresh injection. So that fresh cash injection or capital being not required, you might continue to operate as a private limited company. A simple example of that, which I'll give you, is if you see Dell Computers. Now, that as an organization, Michael Dell, who's the chairman and the owner or the founder of Dell Computers, when they started off, the business was doing quite well. And for about 20 odd years, the business did well. And what they did was, in between somewhere, in order to expand operations globally, they listed the company in different stock exchanges and the ownership of the company became public because the company was generating revenue in excess of $20-30 billion. Now, in 2011, when the business model began to change, Dell Computers' market share in the in terms of the market in regards to the competitors started to come down. It started to make losses. And then Michael Dell again came back to the helm of the company. And what he did was, by investing his own capital, he took the company private. So he bought out all the shareholders in the company. And that company, he said, in order to relieve it from pressures of trading on the stock exchange, because when you have shareholders, they expect results. And the results do not, the shares take a beating, people start selling the shares at loss, and then the company starts to make loss as far as the share trading is concerned. So what he did was he took the company private by buying out all the shareholders, and in order to relieve it from the pressures of expectation which the shareholders, investors have in the company. And that again meant that he took the company private. So after having traded about 21-22 years as a public limited organization, what he did was, in order to sustain and also to stabilize the business, because the market was changing, PCs were turning into tablets and that kind of market, and Dell wasn't ready to shift to that market. What he did was he said, okay, I'm going to come back to the company again, become the major shareholder, and I'm going to take the company private. And this has helped Dell to restructure his business. And at some stage, I'm not sure, but at some stage, the company will again go back onto the stock exchange, or at least one or two different stock exchange, and he will relinquish some part of the ownership and then let the company run as a public limited company. Now, in general, in the UK, what you do get to see is companies which are over 6.5 million in terms of turnover might still be private limited companies. They might not want the capital to come in or have ownership with the public. So here, the companies continue to run unless for various reasons, and these reasons could be additional financing. It could be to look at, taking the business global. It could be to look at, expanding into a different segment. Those are reasons which companies look at, wherein they want to look at public ownership and they want to expand the business exponentially. And that is where private limited companies would tend to follow the route to become public limited companies. Is that okay?
Yeah.
Is that clear enough?
Yes, pretty much.
Okay, good stuff. Now, these are some examples of, different types of organizations which are put in. When you look at public sector organization, the police, anything which I mentioned, which is national ownership or ownership of the state, like the Home Office, the National Health Service here, universities, those are companies which are public sector organizations. Here, the main stakeholder, the main owner of the business, or the main stakeholder as far as running day-to-day operations is concerned, is basically the government, and that is why these are public sector. Private sector organizations which have ownership from investors and owners and members of the public could, because these are large organizations and they trade and sell goods and services across different geographies or countries, they tend to be classified as private sector organizations. Now, this is a chart which kind of, what we've gone through kind of helps you summarize the basics of, different types of companies in a nice little table. So when you look at ownership, you look at regulation, some of the factors, and you can compare that accordingly on a table, very clearly when you look at following this particular chart. Is that okay? So this is a bit of a summary for task 1.1, wherein it says, well, if I say and ask you that, okay, if the size of the business is fairly small, then three, main owners of the business, you can then quickly go to this table and see, okay, I think in terms of ownership, and if I look at the size of the business you're saying is fairly small, that means this business is turning over less than $6.5 million or, £6.5 million, sorry, then this business could be classified as a partnership, or primarily, if I had used the word share, then it would have been a private limited company. So this is where, you could look at the main parameters and the main types of function each type of business needs to have to be classified as a particular type, having a particular type of ownership. Is that okay?
Yeah.
Okay. Now, when we look at, this is a follow-up slide just to summarize, again, when different types of businesses, they look at size and a goal. So for example, if I look at any organization and I compare that onto two factors, what is the size of the organization and what are the goals of the organization, what type of services they provide. So I can list them accordingly by, this particular table, which is from proprietorship to franchise. I can list them accordingly here and then divide them in, this particular chart. So when I look at somebody who's looking at, offering products and services, but they want to offer it solely on the basis that they are the sole owner and their size of operation is small, we can group them into something called small companies. When I look at an example of, say, a franchise, that would mean that the brand and the key services which the company offers are in control of the main company or the founder of the business. But in order to offer these services across different cities, they get into a model wherein they invite public-private partnership. And in that case, those public-private partnerships would be classified as something called a franchise. So McDonald's, for example, as a business, you look at Subway as a business, look at Kentucky Fried Chicken as a business. So food in general, when you look at as a business, they would have a medium size, but here, because the owner has invented or created the product and business and now wants to do expansion, he might choose a route essentially to expand the operations by using a type of a which is called franchise. And here the franchise could be owned by the individual or owned by an investor. And when we look at that franchise, it basically follows the same guidelines primarily, of the main company and the directions from the main company, but the ownership is not only limited to the owner, but also to the investor or the person who has invested into the franchise. And this is normally done to expand businesses across, cities. So one of the models through which organizations can grow, and sometimes if they offer products and services which are consumer products and services, you would see businesses would expand using something called a model of franchise. So when you look at schools, for example, now in our countries we have lots of schools. You have an army public school. The army public school originally would have started as one such setup in the main city, but over a point in time, what has happened is because there's a demand and the children of the forces which work together, basically people who work in the forces are deployed across different locations within the country. What the government has tended to do is create these schools as a franchise, wherein each of these schools are under the same name or the umbrella, follow the same guidelines, but they have become a single entity, and that has become a chain. And here what has happened is you would look at it as a franchise. Is that clear enough? Yeah. Okay. Now let's look at going to the second part, wherein we want to understand the structure of the organization. Now, because there are lots of people and lots of ways in which the business definitely works, there are lots of people who have different role within the organization. And sometimes you will see that it is important for us to understand when you go into and have a conversation with someone, it is important for you to basically go in and understand who is this person, where is he placed in the organization, what role does he have, and how much of decision making power he has within that role. So when we look at this particular, slide, what we do tend to see that people who have a stake or an ownership into the company would be classified as somebody called shareholders. That means that company might be trading onto the stock exchange, and it is a large organization. And here, people who own or have ownership through means of shares would be called shareholders. Now, shareholders are not necessary that they will be working within the company. Sometimes you will see that organizations, in order to retain individuals or keep performing individuals within the organization, offer them something called employee stock option plan. That means the company would offer them to become owners by giving some stock. That stock they can sell in 2 years, 3 years, 5 years, 10 years. But they also then tend to become shareholders or have interest within the company, and that could be done. They don't want them to go away, or they don't want them to leave the company, because they are as they work within the organization, they're an important part and parcel of the organization. So anybody, in short, who owns shares will be termed as something called share. Now, under the shareholders, you will have something called a board, or if it's a large organization, typically you will have people in the board which work and have different responsibilities. So some people will have financial responsibilities, some will have operational responsibilities, some will look at setting the vision, long-term vision, and these could be founder or the main person who founded the company. And in smaller companies, you will tend to see there is no board or an advisory board. There will be something called directors. That means people who own the company and have large stakeholding in terms of shareholding within the organization. Now, sometimes you will see directors having the shareholding. Sometimes you will see these are people who are sleeping directors, which have shareholding but have no active role in the company. So they sit on the board. But what they sit on the board means they attend general meetings, they look at direction, strategic decision making, and they are a part and parcel of that. Sometimes when you bring in external talent to lead the company and kind of provide leadership and take the company from one location or one position to the other, you will see that people who join in on that position are classified as people who are directors. That means people who have supreme power to make decision, and decision is binding, and those people will be classified as something called directors. Now, under directors, you will have a lot of different types of people. Now, when I say different types of people, you will have people who primarily are workers, who are working in the middle management, senior management. They work in the frontline services, and they then tend to kind of look at working on day-to-day activities or functions within the organization. So here, what I would primarily do in this case would be, when we look at, say, an example of Unilever in this case, and when we look at Unilever, which is an organization, as a company, they are present pretty much everywhere in the world, right? So when we look at Unilever structure in terms of ownership, is basically divided under as shown on this slide. So here, when you see, it is a company which is primarily a British company, but also a Dutch company, because the Unilever was essentially initially a British organization. Over the years, the Dutch or the Danish have invested, and they have also brought in, and there was a merger, and obviously because of which the company essentially became a merged entity, and that is why they are now termed as Unilever. Now, the reason why they have done this, and it has happened over a point in time, is the company's operation are very huge. So what has happened is, you have independent entities which work within each country. So if you look at Unilever, they make pretty much P&G, Procter and Gamble, and Unilever. The reason I've taken this example is they pretty much are present in most of the countries in the world, say 190 countries in the world. They produce everything from detergents to butter to brands, soaps, everything that we use on a day-to-day basis. So they are companies which are categorized in something called fast-moving consumer good, or FMCG companies. turnover is in billions of pounds or billions of dollars, and they typically would, have a multiple complex structure running these set of companies in different geographies. Now, the reason I say this is when you look at Unilever in, say, for example, UK, and you look at Unilever in Europe, Unilever in Americas, Unilever in other countries like China, India, Pakistan, you will see that they have a local entity or a local company which is formed in that geography. Now, because the operations of the companies are so huge, what tends to happen is they create something called joint ownership. And the joint ownership of an organization looks at, because they want to save taxation, they want to look at complying with the local legislation in that geography. And because they want to do that, their structures tend to be complex. Now, when we look at, their structures being complex, what we tend to see is that you will normally see that because they're also listed in different stock exchanges, what that would mean is that the company has ownership in, local countries as well. Means people or employees working within the organization have ownership, and that would mean that that company would typically also have maybe a tie-up with some other company, and they would then have a joint ownership. So when we look at, say, Unilever as an example, present in Italy, they have something called a joint ownership with a company called NVXR, which is an Italian company, and it's a competitor. But what they've done is they've come together and they offer these same products and services which Unilever produces. Some of them are branded products in the name of XOR, NV, or some of them are branded products in the name of Unilever. So in order to be in that market, what they do see is that if they come into the market and they want to kind of, sell their products and services, it is going to be a big competition leading to a lot of, duplication. So what they tend to do is do a tie-up or maybe some sort of create some sort of a partnership with a very, let's say, with a partnership with a locally strong organization, and that partnership then has joint ownerships within both the companies, and they then go to market together. So in the case of Unilever, just to understand, this slide, the idea is to wake you up, and with this, the company has different tools within the structure of the organization is different. People who own shares will be called shareholders. People who have absolute authority in terms of decision making, might have ownership in terms of shares, would be called either directors or board, will be on the board of directors. And then when we look at this company's operation in different geographies, sometimes you will see, because of the scale of operation they have, they sometimes, in order to comply with the legislation, in order to make business favorable, to save taxes, to serve more consumers, they get into partnership or joint ventures. Not the word partnership, they get into something called G or joint ventures with the locally strong competitor in order to address that market for products and services. And that tends to happen. And in that case, the ownership of that entity, which gets created because of JV or joint partnership, you will see, has joint holding with the head office company and the local entity. A simple example I will give you, which I think you will be able to correlate, is you see our countries wherein Toyota and Nissan produce cars, right? Initially, when they started to come and sell cars in the country, they were fully imported from Japan, correct?
Yeah.
But over a point in time, what has happened is, in order to reduce the price of the cars, to comply with the taxation, and also to create jobs in the economy and have a long-term stay, what these companies have, Toyota, done is they have created joint ventures with a local company in your country, or like India and Pakistan, to produce parts and to produce and assemble cars in the country for the public, for the masses. And that had created something called a joint venture, wherein the main part of the assembly of the car, like the engine or maybe the electronics, still from the head office, but all the other parts in terms of, the assembly, when we look at upholstery, the tires and other bits and pieces which go into the car, are now being locally produced with a partner that they have tied up. And together, what they've done is they have localized the production of Toyota and, Nissan cars in the country by creating jobs, but by forming a joint venture. Is that okay?
Yeah.
So what that has meant for the consumers is the price of the car has come down. It has created jobs, and the government has helped the company because the government, they've also complied with the government legislation because they are able to save a bit of tax, or maybe they have to park a bit of profits and pay taxation in that country rather than paying and taking all the money back to Japan. So this kind of ownership or the partnership, not the partner, this kind of joint venture or joint ownership which has been created between a local company in Pakistan and the head office of the company like Nissan or Toyota in Japan, has created a local business which has both ownership from the local organization, which was a company based in Pakistan, also has the Nissan company in Japan also has ownership of that particular company, but the stakes might vary. So the local partner might have maybe more stake, but the the foreign company which has come into and started operation over a point in time will have lesser and lesser stake, and that would become Nissan Motors Pakistan Limited or Toyota Motors Pakistan Limited, something like that. So over a point in time, this particular venture would become independent, but it will still have direct tie-ups with the head office to be able to supply technology, engine, and other bits and pieces which are required to assemble the car, and that would localize the assembly, but at the same point in time, make the product more cheaper and more affordable to masses in that geography or that country. Is that okay?
Yeah.
So it is critical for us to understand is because when we look at business and when we look at business environment, a lot of companies now have products which are sold in different countries. And in order to kind of make these products and price points viable, what companies have started to do is they've started to form joint ventures with local competitors or companies which are in that domain. And that allows them to overall reduce the price of goods and also comply with legislation in that country, and as a result become a local company as against a foreign brand. Okay.
Yeah.
Now that is what I've depicted here about Unilever. So if you see Unilever, it's a Dutch-British national conglomerate. It operates in 190 countries. They serve about 2 billion customers every day. So whether you buy soaps, oils, soups, ice creams, tea, whatever it is, they sell pretty much every sort of product that we can think of. They are pretty much in, they have Unilever as a company has 30% market share in food products, 33% in personal care, 19% in refreshment, and 18% in home care products. And they, as a company, across the globe, when they operate in 190 countries, have more than 171,000 employees. So in Unilever is present in Pakistan as well, I think. And when you look at, they might have 2, 3, 4,000 employees working within that company. But that will be Unilever Pakistan Limited. It won't be Unilever, UK Limited. And that is a company which basically sells the products locally, markets the products, and employs a lot of people within the country, and then complies with the law and legislation of that of that geography. This is just to show you a structure. So Unilever has something called the divisional structure. Division means each of the business. When you look at the soap division, when you look at the foods division, or when you look at the home care division, these are divisions which are big. That their turnovers itself are $2, $3, $4 billion for each of the division, each of the products. So here, each of the division has their own chief executive or a managing director, and they report into something called, the board. So here, just to give you an example, as we have grouped the business, the previous slide, into these 4 sections, right? Now, if I look at this chart, Paul Polman is the CEO of Unilever globally. Underneath that, you have financial officer, HR officer, other key functions which basically are managed as from the head office. But because each of the divisions are big, you see that there is a separate person who manages the home care product division, because this is one of the largest revenue generators for Unilever. And if they look at a particular geography like Europe as a geography is very big in terms of financial turnover. That means it turns out a lot of money and turnover in terms of finances. They have a separate president which manages just the European operations. So within Europe, you have 27 countries, and each of the individual managing director of the company actually reports into something called the president of your Unilever Europe. So they have very complex structure, and that complex structure, the reason I'm explaining that is it helps us understand the various stakeholders in the organization. A large setup, a large company will have lots of shareholders within the organization, and a small company or a small setup will have limited number of shareholders or people who actually have day-to-day working within the company. Now, if I look at a small business, like a shopkeeper, let's look at a small business like a shopkeeper, which basically sells grocery and other products. You see, the owner maybe is the one of the business owners. He's one of the person who works in the business. But apart from that, you will see maybe 3-4 employees in the business who handle day-to-day operation of like shelving the stocks, or looking at taking orders or serving the customers on the till. So the business has maybe 4 or 5 employees, and each of these employees, when they work within the organization, I can group them under employee. If there is one owner, then the owner, or basically the director of the company, which is because as a shopkeeper is a sole proprietorship, you will see the owner is one category. You have employees, which is the second category. Now, because the shop sells a lot of goods and services, and they buy it from their suppliers or various suppliers, suppliers become the third stakeholder. Correct? And because this business turns over some revenue and makes some profit, at the end of the year they have to publish the accounts or follow some regulations. This then looks at the government becoming one of the stakeholders. Correct? Because they have to comply with law and legislation. And then if they do not deal with anybody else, then this has 4 types of stakeholders in the business. One is the owner or the investor. You have employees, staff, which supply the material to the shop for as and when the orders come in, and things like that. So this, as a small business, has only 4 type of stakeholders. That means if the shop is being run and you have no customers buying your products and services, then the business would fail. Because at the end of the day, as a shop, when you run, you are supposed to sell your services, or you're selling your goods that are in the shop, things like grocery, whatever it is, like a newspaper and things like that. If there's nobody to buy, then what will happen is the business will fail, isn't it?
Yeah.
So if we do not have customers coming in and shopping in that shop, then the business would fail. So one of the important stakeholders in the business would be customers. So if we don't have customers, the business would fail, the business idea would fail, and the whole setup will fail. Now the other side is, if you have lots of customers coming in and owner is the only one who's serving the customers, he at some point in time will be on the taking the money, also maybe going out to serve the customer. That will also create a bit of discomfort with customers, because waiting time would be there, or a lot of them would not be on time, and there'll be lots of things to manage. So here, employees, if he doesn't have in the shop maybe 1 or 2 employees, whatever it is, depending on the size of the operation, employees become an important stakeholder of the business. So without employees, the business will not be able to serve customers appropriately. Now, in most shops, you see husband and wife working, or you see a family working, but at the end of the day, they all become employees at some stage, and that is where they serve the customers. So depending on the size of the business, the stakeholders of the business can be many, and they can be quite varied. So in case of Unilever, because they have something called corporate social responsibility, they have to look at environmental protection. They have what you call NGOs, non-government organizations, or charities which work and keep a check on their products and services not creating environmental pollution and things like that. So here they have other stakeholders apart from investors, customers, suppliers, government. They will have NGO. They'll also have people which are basically in the public domain, and they will kind of look at having a bit of a check on the organization, which would mean that they kind of fall into something called civil society. So when we look at CSR, or corporate social responsibility, or responsibility of the organization towards environment, not polluting the environment, you will see that there are lots of civil organizations which will keep a check on company operations, and they will have to produce reports and do audits across the year, and they become a part of something called civil. Because there are lots of employees, it's not just one, two, three. Because there are lots of employees, so that is why this category also becomes important, and they are also a stakeholder in the business. Sometimes, as I mentioned earlier, when you see employees given stock option plans, so they also become shareholders, but they are also an integral part of the organization. An example here I would also give is to relate, like we have John Lewis Partnership. Now, John Lewis is a big retailer in the UK which sells pretty much everything. They have their stores. Now, here each employee is also the owner of the company. So they have certain number of shares depending on the number of service, and they are categorized in both the sides. So you are an employee, but you're also a partner or a stockholder in the company. Is that okay? Now,
Yeah.
depending on the type of stakeholders, the priority also will be different. Now, who is important within the company when they say something? Do you think a manager is important, a supervisor is important, an employee is important, or a director, when he says something, he's important?
Director is most important.
So when you look at, we can then spot on. So when we look at, their area of responsibility, and we also look at their area of influence, we classify them on the basis of something called priority, or maybe the weight that they can kind of put on behind any particular decision. So this help us to kind of put a bit of importance or significance on the type of shareholders. Now, going back to Unilever, this is how their business is structured. I should have actually had this slide slightly above, but this particular structure of the organization, because they are present in very many countries, they have product type structures, they have corporate team which is in the head office, and they also have geographical divisions or divisional structure. And if I have to expand this, in each of the divisions they have 4 product divisions: personal care, food, home care, and refreshment. And each of the division will have a president or somebody leading it, but that person will be having reporting from all the different countries, managing director or the person who's the head of that particular product division in that country. So it becomes divisional. In the corporate team, they are based in the head office. They look at making and setting the direction for the business for 2 years, 3 years, 5 years, 10 years. So they are basically, working on strategic objectives. And the geographical divisions primarily divide the group into 3 different types of geographies: the Americas, North and South. You look at Europe. When you look at Asia, Africa, Central and Eastern Europe, because they are smaller economies, they are grouped together into one group. Sometimes companies call it EMEA, Europe, Middle East, Africa. So when you look at this categorization, which happens wherein a head within this particular region would be having reporting from different people in different countries. Because the business is so large, they create these divisions to better manage and operationalize the business. And because the person heading the business is from this particular region or geography, they understand the culture, the background, the markets quite well. And that is why the divisional structure or the geographical structure of the organization works better. But if it was a small, for example, when I look at, say, an ice cream business, in say Pakistan, I know there is, what is the popular ice cream brand in Pakistan? Walls. Yeah?
Yeah, it is.
Am I correct? There is something called Walls. Walls ice cream, is it?
Yeah, Walls and Umar.
Yeah. So when you look at Omar and Walls, they were small businesses which started in 1 or 2 cities, but over the years, these guys have expanded and given a run for their money to Unilever and some of the other brands, which have similar businesses, but they are as successful because what they have been able to do is they know the customers better, they know their requirements better, and they have produced goods or localized goods which are meeting or exceeding the requirements of the local consumer. And a lot of multinational organizations have taken time to kind of, follow that lead. So here, when they look at their business, they might not have this or these 2 structures. They will have maybe a corporate team here. They will have a regional office here, and then they'll have smaller city offices from which the distribution of the products are sold, because it requires refrigeration and products are then sold into different cities through distributors and stockists and things like that. So they might there, because it is not a company which is present in many countries, it's just Pakistan. They might just have one divisional structure wherein it will be the head office, then the regional offices, and then the distribution center or local offices in cities, branch offices as we call them. Is that okay? Let's look at, when we understand the type of stakeholders and we know what kind of role they play, how we need to understand is what kind of structure they help develop within the organization. Now, if you look at Japanese organization, they have a very autocratic structure. That means the person at the top might make a decision and everybody in the organization follows. An example of that I would give you is army, for example. When you look at the general making decision on the top, everybody within that division or the regiment or whatever, they will follow that order. They cannot go against that order. So here what you see is an autocratic type of system wherein one person has the sole decision making power and his decision is more or less final. And I've given you this as an example is, when you look at different organizations and different type of structures, what you will see is that they have different type of leadership styles, and the type of stakeholders within the organizations kind of help shape the culture and type of organization or the image of the organization it portrays externally. So when you look at Japanese and Korean organizations, they have autocracy, and their structure of the organization is quite hierarchical. That means there'll be, if you have to speak to somebody senior enough, you have to go to your boss only. Your boss will go to your line manager, they will go to your general manager, and then in general they will go to, if the problem is not solved, go to the senior management. When you look at European organizations, they typically tend to have something called a functional structure. The functional structure is, what they try and do is they group people together into the type of function they perform within the organization. So people who work on products or basically look at product engineering, creation of products, new features, they are grouped together into something called product function. So when you look at an organization like Microsoft, you will see that they are grouped as a functional organization in terms of products. So Xbox gaming as one product, your Bing or search as a second product, your Windows or operating system as a third product, and then you look at the cloud-based computing services and other things that they are producing, being the other side of the organization. So what they have done as a large business, it is US centric, but these organizations have a very flat organizational structure, and what they do is they group them according to the function in which the or function or type of services the businesses provide. Now, so in task 1.3, what we are looking at doing is we are trying to understand what type of responsibility each of these stakeholders will have when they work within the organization. So here what we want to be able to do is, in 1.3 we want to understand how the structure actually supports the various objectives which the stakeholders want them to accomplish. Now, who is the stakeholder? Can you recall who is a stakeholder?
Stakeholders are the group of people which are directly or indirectly being affected by the business.
Yes. So if I have to say,
carry responsibility.
Yeah, if you give me an example of one stakeholder.
Investor, employees, customers, suppliers, government, NGOs.
Brilliant, right. So when you look at stakeholders here, if we say the first stakeholder you've said, say for example employees, or you've said directors of the board. Now one of the stakeholders will be the stakeholder in terms of shareholder. His main objective will be that, okay, I'm not too involved in this. All I want to know is at the end of the year how much the company makes, how much profit does the company make, and from that profit how much of earning per share I get in terms of as a dividend. Now his or her major expectation from the business or the company is the profit the business makes or generates and what they get as a dividend at the end of the year. So the priority or the objectives of the stakeholder in this case, when I talk about shareholders, is different from the priority and objectives of the employee. The employees might have an objective that they would say that, okay, at the end of the year, I want to get a pay rise. I want to get paid monthly as per the contract, and their main aim would described in my contract year on year when I work for this organization. So you see the difference in terms of priorities these stakeholders will have is, as an employee, you want to get paid, you want to get the perks and services which you have, which are described in your contract. But when we look at a shareholder, somebody who has ownership in the company wants to see how much profit you make. At the end of the year, they want to see, essentially, let's put it this way, how much share dividend or earnings per share they can get as a dividend from the organization. If I look at suppliers, their main function would be that they want to see that, okay, if I supply any goods and services to you, and I'm a contracted supplier, then I should be paid in 30 days against the invoice which have been raised, or paid in 7 days, whatever terms and conditions have been negotiated. And their expectation in terms of objectives would be different. That when I supply, when we deliver, you sign the delivery off, we raise an invoice, you pay us in 7 days, and then you keep giving us time in terms of minimum order quantity for you to supply year on year or month on month or week on week. So their objectives will be slightly different. So here the main thing that we want to understand is, we want to pick up, maybe when you start doing the assignment, what you have to look at is define what are stakeholders, as you've rightly said, employees, directors, staff, suppliers. And each of the stakeholders, whether taking an example of an organization, you will have to look at how their objectives are different and met, how they are met. So here in this case, what we want to do is understand the objectives of each of the stakeholders, and then explain how they are met. Is that okay?
Yes.
So when we look at structure of the organization and the culture of the organization, that kind of feeds into how these objectives are met. And depending on the the leadership which is provided by the people in the organization, it helps them clearly define these objectives. Now, on a day-to-day basis, an employee would be given a job description, right? When you join a particular job, you are given a job description, and you are given then a probation period or a certain number of weeks to get comfortable into that job. Now, once you're comfortable into that job, your line manager or your person, somebody who's managing, would expect very clearly that this is something that you should be able to achieve on a day-to-day basis, on a monthly basis. And towards the end of the year, a review is done, and they find in the performance appraisal or the review that you're meeting your objectives, or you're not meeting, or you're exceeding the objectives. That will kind of determine the type of rise in salary, or say, for example, a promotion, or what kind of person you receive, additional responsibility you receive for the next year will be decided. Correct?
Mm-hmm.
So when we look at somebody joining into the organization as new, they are given a bit of time to settle down in the organization, because they want to familiarize themselves, understand the policies and processes. And once they understand the policies and processes, become used to it, then that person will be able to run and do the job more effectively. A simple example in this case would be, if somebody comes in and joins new in the sales side of the organization, what they will need to know is, they will need to understand how the quotation are sent, what type of customers the business handles. Do you go out and take calls? So sometimes you will see a line manager will go out on 2 or 3 calls with you just to explain how the account management is done, or how you would want to deal with the customer. How do you want to provide information? And once the person becomes independent, then the line manager leaves the person on his own, because they say that you've become comfortable now and you can manage it. And what your aim is to then is to maximize the business month on month from that account. And that being put into place as an employee, once you have the job description and you had this probation period to settle down, you clearly understand that how these objectives are met, what efforts you have to put in to get the sale. And then once you start getting that, you are then left on your own, and then you start performing. Correct?
Okay.
So this is how the objectives from different people or different type of stakeholders in the organization would be looked at, and they will be slightly different. Okay? So just to summarize the session now, what we have. So today it's been a bit of a long session, because I think the idea is, I want to get you to understand some of the things in terms of how the delivery is. It is quite detailed to a certain extent. And I think, after I do a number of sessions, we will send you some sort of a feedback to try and say, if you're able to follow it, is it too detailed? Is it brief enough? Or how are you going about it? And then we'll tailor the delivery accordingly. But I think from my point of view, I'm quite happy with the, I would like to get some comments from you, but I think in general, I'm quite happy with how the session ran. We had a bit of an issue in the beginning with regards to the, the voice, but that has been resolved. So just to summarize, and I'll take your comments after this, just to summarize, what we've done today is we've understood how the structure of the company is done, structuring of the business is done, types of structures, and, the types of companies which are formed. We've looked at briefly the types of stakeholders in the organization and what are their roles and responsibilities. And sometimes when the objectives have to be set for these stakeholders, how these objectives are set, what is the role of the culture and the structure within the organization, and how this culture and structure of the organization helps the objectives to be set and then met for different stakeholders. Is that okay?
Yes.
Good stuff. Any questions at your end?
Yeah, I was just going through the assignment brief yesterday, and there were like 2-3 questions which I want to ask from you regarding the word limit that was around 2,500. But as the assignment brief content says that I have to include the diagrams and tables and stuff like that. So how am I going to how am I going to count the number of words in diagrams and tables? Like when we write a simple assignment, I know like there's a simple content writing in paragraphs and stuff, I can easily calculate the number of words I'm writing. But in case of diagrams, what will be the rules and I can say what will be the rules I'll be following in order to meet the word limit?
See, my suggestion to you will be that when you're looking at the assignment brief, the word count given is primarily just as a recommended word count from a point of view of reference. It has got nothing to do with, you could send me a 10,000 word assignment, but you need to be happy with it because that needs to cover most things which are defined in the task. Now, the reason why there's a bit of a, let's put it this way, two sides of the coin. The first is, the reason why this word count has been given is that it has been given for you to kind of understand clearly that this is something which is a mandatory requirement going further when you look at going into a university, and at some point in time what they do is they have to ask strict into what you need to write in terms of the words. Now, having said that, the flip side of the coin is that because you're getting to grips with writing assignments, which might be slightly different as against taking an examination, my suggestion to you would be, if you understand the command verbs, which is something which I had briefly asked you to look into at the time of induction, and the other would be to address the task, so that if you feel that you've addressed the task, because this particular qualification that you're doing only has a pass or not yet pass, or there's no what you call merit or distinction. So in order to look at doing the task, my suggestion would be, if you just provide what is being asked for, nothing more, nothing less. So like in this case, it says instructions, task 101, it says create a portfolio with the following details. So a table differentiating purpose of public and private sector organization, right? Now, the reason why we do also some of these things in teaching backwards is to give you a clear idea that this is what is required. Now, if I look at part A, this is what is required. That's it. Do you get it? So this says a table for differentiating purpose of public and private sector organization. This case table gives you the summary, and this is meeting the task A. So you have to think objectively.
Exactly, copy paste this thing, or can I?
Word, in this case, you wouldn't probably look at a word limit on this, Don't worry about the word limit. As long as the task what is being asked for, you're answering and providing that information, that will be good enough. It talks about a journal mind map showing main stakeholders of the organization and their objectives, regulatory bodies. This, if you put this chart in, this chart, and you put this chart in, which is the different stakeholders and their priority, that would do that task, B.
Right.
Is that okay? So that would basically do A and B straight away. And that covers your learning outcome 1. As simple as that. Is that okay? You might have to explain this in some words, because I'm only showing you the PowerPoint slide. So maybe what you could do is you could put a picture or a table of this under the task 1. It says table differentiating. So you might define what is a public sector organization, you might define what is a private sector organization, and once you've defined that, you can put this in. That's it, and that will do the task.
Okay.
Is that okay? See, at level 4, the idea is you want to look at what is being asked and you reply to point what is being required in that task. That's it. So if I ask you, how old are you?
Particularly talking about this task, that is task 1 regarding this portfolio, what I'm saying is that I have some ready-made stuff on the slides. So can I just pick them up from there and insert that in my assignment? Would that be okay? Would that be considered as plagiarism or something like that?
Absolutely okay, no problem.
Okay.
Okay.
Right.
So for this, basically for this unit, what they're asking you to create a portfolio. That's it. So this is going to be, it's going to be more visual, this assignment. But for example, it is diagram explaining Michael Porter's 5 forces model. What we will do is, when I cover this up with you, we are looking at explaining what is by Michael Porter, who created the 5 forces model. We will look at that theoretical model, and then instead of putting the diagram, what we will do is we will look at explaining that in 30 to 50 words with an example. That in what case we use the 5 forces model. So just putting the diagram might not be, meeting the task. So you have to put the diagram of a 5 forces model, and once you've done that, in 30 to 50 words, you will explain why and where we use Michael Porter's 5 forces model. That's it. Okay.
Great. Yeah.
So look at the assignment objectively. What is asked and what you are providing. That's it. At this stage, this assignment does not require you to do lots of analysis, lots of evaluation, nothing like that. This is a very simple unit. We have to follow it, and it's a good thing that you've asked me this question. So it says a table showing the impact of fiscal and monetary policies. So by putting a table, you cannot show the impact. So what you have to do is define what is a fiscal policy, define what is a monetary policy. When I cover it in the next presentation tomorrow, what I'm going to do is, then we are going to talk a particular country like UK or Pakistan and look at how the government uses these instruments to drive supply and demand or increase growth, kind of increase the GDP of the economy. And that is something which I will have to explain in 30 to 50 words. So I will put a small picture down which defines fiscal policy, or a graph or a chart which basically shows how the policy implementation is happening, but I have to explain it by 30 to 50 words to meet that task. Okay. Good stuff. Any other question?
Yeah. One more thing. Just a minute. I'll just go through it and ask. Okay, so would you suggest me any readings from the book? Like you were saying that you will be telling me to read some pages out of the book that could be an additional help for me when I'll be doing assignments.
So what I'm going to do is, after this, I'm going to send you a quick email with a copy of the presentation, though I've uploaded it here, and I will also refer you to the pages that you need to read in the book.
Okay.
Okay, it will be specific pages because this book covers the full unit. And this book is not just used at level 4. This book is at level 5 also, when you have economics in business, level 6, which is economics in business, and level 7 also. This book will be business environment. The name of the unit will change, and when you study at different levels, we will start to study in more detail this content. For example, when we look at policies which the government uses or fiscal instrument the government uses, they are used across from level 4 to 7 till you do your master's degree. But the depth in which we will start studying will be higher as you go up in the levels. This book has a very detailed knowledge about some of these things. My idea would be to try and recommend you a few pages that you need to read to develop understanding, the basic understanding at this moment, to understand the requirements of meeting the criteria of assignment brief at level 4. Okay?
Right.
Okay,
so up till now, we do not need to touch the Harvard referencing for this particular unit, or we'll be doing this in this unit too?
No, the Harvard referencing you will cover in research when we do the unit, but there will be, when you do some definitions of policies and other bits and pieces, you will need some references to be put. Like if I put a diagram of, say for example, Porter's five forces model. So to give you an example here, 5 forces model, right? So if I pick this up just as an example, and I go in and from Mind Tools, if I have to put this into a document, if I bring this model into a document from this particular thing, I have to put a reference. Where have I got this from? So here it will be, say, figure. How will I put figure 1 if this is figure in the assignment? And I will say, Porter's 5 forces model, right, comma, that's it. And then I will put basically comma and I'll put source. So where is the source? I've taken it from Mind Tools and I've accessed it on 2017. Now this is referencing just for the diagram when you are covering it in the assignment. But when I go and develop my bibliography towards the end of the assignment, what I am going to do is I have to pick up the site from which I have picked this picture up, right? So what I will do is I will put this up here, say the first reference, and then I will say assessed or accessed on, sorry. I've today, accessed the website. So I've accessed it on 17/02/2018. This will become Harvard referencing. But this is only the website. But when I look at it from a book, say example, I find this from the business environment book on Moodle, then in that case, what I will do is I will write the date author style referencing. So first I write the name of the author. So in this case, if I go into the book here, which is business environment, and in this book, say for example, this book is, one second. So if I have uploaded this book, just to give you an idea, this book is written by Worthington, the author, right? So in this case, to reference it from a book, what I'm going to do is Worthington, and then this book was published, which is this edition. So it was published in 2006, right? And then what I'm going to do is, if I have to do this, say, as a referencing within the paragraph of the assignment, this is how well I'll do. But apart from that, what I'm going to do is from which page I've taken this, what do you call it, Potter's 5 forces model. Example, if it's on page 232, that will become a referencing within the text. But if I have to then put this up within the bibliography, what I'm going to do is write the name of the author, and then say 2006 as a publication, and then from which chapter I picked it up from. So assuming the chapter is 5 forces, or basically external forces in the business environment, and then page 232, and then towards the end, or if what the bibliography will look like. Is that okay? So there is referencing which we will teach you or go through in any case when we do research. You can go through the referencing part of the presentation of how to reference primarily when you look at the Harvard referencing presentation that we have uploaded here. But when you do diagrams and when you take material from somewhere, you have to reference it like this. And then underneath that, what I have to do is, okay, it is only asked for Porter's 5 forces model, but that's fine. I've put the 4 or 5 forces model talking about this. But what I have to do is I've also to explain what is 5 forces model. And when I explain 5 forces model, what I a bit of the 5 forces. So for example, if I have to here talk about competition, talk about substitution, the buying power buyers and suppliers, and talk about the threat for new entry, which is threat from substitutes or threats from competitors. I will at the end of the day give a bit of an example to cover this off, and that would mean the assignment is covered or the task is covered. So I will write something here which will be about 30 to 50 words. Let me just put, say for example, in particular, somebody, if they've submitted this before. So in this case, that is what they've done. What is 5 forces analysis? What they've done is they've done a bit of definition here, explain the model, and then put it across in this particular diagram. Now this is that task which is meeting that task criteria. Can you see that? So they have defined Porter's five forces model. What does it do? Explain each of the components, and then within that they have taken example of Microsoft or something to explain, briefly that why it is used, where it is used, in terms of the analysis when a company wants to do study what are the factors which externally affect the product of the business.
Right.
Okay, so this is where ideally you will need to, when I look at this particular task which is given up in the assignment brief here, it says a diagram explaining Porter's model. That is what will meet the criteria. Okay.
Right.
I will send this to you as an example. What I'm going to do is I'm going to ask you to refer to some pages, in any case in the book, but I will send you a particular handout, which is a specific handout for that we've covered, 1.1, 1.2, 1.3. Now you cannot copy that handout and put it in your assignment, but that is to give you an idea of how this task set, or how these tasks have to be attempted. Is that okay?
Yeah. Okay.
That's fine. Good. Anything else?
So no, it's pretty much clear up till now. So tomorrow we'll be meeting at this same time.
We are looking at doing tomorrow. I think I put 10 a.m. early, slightly early. So we'll start at 10 a.m. tomorrow. Is that okay? I have another student. We have another student who's doing the same course called Wajid, and he's from Dubai. Originally, he's not based in Dubai. So I'd send the invite out to him today as well, but I think he's not been able to join. Let's see if he can join tomorrow. But there are about 3 or 4 students, in particular, who are going to be, doing this course. So sometimes we'll have 1 or 2, or sometimes we'll have at least 3 or 4 joining the same course.
Great.
Okay, so we'll have a bit of interaction also going, as far as the teaching is concerned.
All right.
Okay, good stuff, Malia. Thank you so much for joining this session, and I will catch up with you tomorrow for learning outcome 2. And I'll send you this email out in a couple of minutes.
All right.